Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Jay Pestrichelli, CEO of Zega Financial. Jay, it's great to have you back on the show. Welcome back to Trade Talks.
Thanks, Joe. Great to be here.
All right, and of course, a lot has happened since we last met in 2019 back at the MarketSite studio, and I can imagine that you're hearing from investors that there's concerns about inflation or COVID slowing down the remarkable recovery and economy that we saw. What are your thoughts around that?
Yeah, we're hearing a lot, especially the last couple of weeks about, hey, Jay, this market's had really an incredible run. We're pushing all-time highs. I'm really kind of, concerned. Should we stay invested? Should we try to take a little risk off the table? How do we proceed from here? And, the general outlook is, well, where else can you go, right? It's the, traditionally, we've been taught that bonds are a way to diversify equity risk. And, but these days, it's probably just as risky as of a position, right? We see that rates are low. We know that a rising rate environment is not great to be long bonds in that kind of situation. But maybe that also puts pressure on stocks. So how do you solve this question, right? This is what we get all the time from our investors. And really, even our professional investors and advisors have that same question. And our answer is stay invested, but be hedged, right? Take some of the risk off, manage your risk. But, don't come out of this market that has been very, very strong. I did a quick little look before we hopped on the call here. And since the election, since the market kind of broke out of the election last year, the S&P's up 23%, right? If you thought, hey, the market hit an all-time high, I'm going to wait for a retracement, you've been waiting a long, long time. And so that's the risk of trying to time the market of kind of being in, being out. People don't realize that the market is at an all-time high or within like 2 or 3% of an all-time high about 30% of the time. So while it feels like, toppy, it's not unusual for markets to be at these kinds of levels.
Right, and Jay, it's one thing to say stay invested, but remain hedged, and not every retail investor or advisor knows how to do that and be competitive with a professional. So tell us about an ETF that allows that to happen within an investor's portfolio.
Yeah, thanks for teeing that one up. That's right. There's a lot of ways that you can hedge. You can hedge with your own options, and maybe I'll give a trade in a moment on that. But if you want, rotate into, there are funds out there. There's ETFs. There's mutual funds that actually are hedged by their very nature. We recently released one, ZHDG is the ticker symbol, but it's not the only one out there. There's plenty of them out there, and essentially it allows you to trust a manager who knows how to hedge all the time and protect, but still give you exposure to the growth you expect from an equity market. Many of the hedged funds, not hedge funds, hedged funds that are out there give you the ability to capture 60, 70, 75% of the upside of the market, but still have protection in at the same time. And they remove the reliance on that, bond portion of a portfolio to give you that, non-correlated protection.
So Jay, let's say I have a basket of Nasdaq stocks in my portfolio, which of course have certainly outperformed from the March 2020 lows. What is the way that you could potentially hedge that? Because that's one area where you want to be concerned is many of them are sitting at their all-time highs. Yeah,
I mean, in the Nasdaq in particular, right? The Nasdaq, the mega caps have absolutely seen a lot of growth since the bottom of last year, and even this year, the outperformance has been very interesting. So it could be, for those of you that understand how to trade options, it's not the hardest thing in the world to put on a long put spread, right? I took a look right before we hopped on that, if you wanted to put on a hedge on the Nasdaq 100, the NDX, for example, you could buy an at-the-money put, sell a put, 15, 20% out of the money, and give yourself some protection between now and say November or October, which traditionally, if you're going to have little jitters in the market, we see that in say September and October. So you can hedge with a Nasdaq position, long put spread, an at the money put, sell like a 15% out of the money put, and that will cost you maybe only 2.5 to 3.5%. So it gives you the peace of mind that if the market really sells off, if we really do get some fear into this market, you're protected in that first 15 to 20% decline of the Nasdaq, which really, let's face it, is going to probably protect you pretty much in the S&P 500 as well. And so if you're willing to do it yourself, you could create some protection with a very, affordable long put spread.
All right, Jay, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.